Howdy, Jacob here. Today we're looking at FMC Corporation. Let's dig into some financials. We see that they have a market cap of about 7.8 billion on 10.5 billion enterprise value in the chemicals industry. It looks like they're an agricultural science company that provides crop protection, plant health, and professional pest and turf management products. Very cool. Just under the 4% dividend yield we're looking for. Margins are actually both up. That's pretty great to see. 38% to 40% on the gross margin side, and then 19% to 21% on the operating margin side. They've paid a dividend every year for the last 10 years. And besides the brief pause and increase in dividend in 2016 and 2017, it has increased at least 9.4%. So that's pretty cool. Return on invested capital appears to be averaging out at high single digits, low double digits, probably right around 10%, which is likely higher than their weighted average cost of capital. So that's a plus. They're increasing business, which is awesome. And let's look at that debt. There was a little bit of debt here. So 570 million cash on hand with 3.3 roughly billion in short-term and long-term interest-bearing debt. So from a balance sheet perspective, not crazily attractive, still a bit risky. Their 5-year average free cash flow is about 500 million, and they pay out 285 million, so that's 50 to 60% payout ratio. But a 500 million average to their debt is still about 6 to 7 times their 5-year average free cash flow for debt, with only 572 million on hand. So when is this debt due? That's if you're looking at this company and want to do a deeper dive, you're definitely going to look at when that debt's due, because if a lot of it is due soon, that could be concerning and alarming. But if it's all due after 2030, they will likely have time to allocate a lot of their cash flow or a bit of their cash flow to dwindle down that debt to get to a more attractive ratio, in my perspective, of price to free cash flow. Their use of cash is pretty heavy in dividends. Like I said, about 50 to 60% their current 5-year average free cash flow. And then they do use a little bit in acquisitions, a little bit of share repurchases, and then they do issue more debt. It looks like they've issued more debt than they've bought down, which we want to see the reverse for the future. We want this company, I think the dividend of 50, 60%, I may drop it down 25%. And the reason I'm doing that is because this company historically has also used a lot of cash for acquisitions and buying back shares. We want them to have the capability of being able to buy back stupidly cheap shares if that becomes available. And then we do want this company to start focusing on paying down some of that debt. I think if they can allocate, obviously it depends on what other use of cash they have. If an acquisition makes sense to increase margin, to increase revenues in line with free cash flow, that might make sense. If shares are stupidly cheap, we want them buying them down. But if there's no other reason to use the cash, we want them to be paying down that debt. So I want at least 20% of the free cash flow going towards paying down that debt, unless these opportunities arise elsewhere to where paying down shares makes more sense or making acquisition makes more sense. So that's the reason for the dividend cut. They can afford it as is. It's 50 to 60% payout right now, but I think I want them to cut it. And like I said, the reason it's always an art to calculate present value of companies, and it's also a balance of what do you want the company to do versus what they should do, because obviously. But there's a chance that there's a higher probability of them not cutting the dividend just because it's ugly. It's an ugly look for companies to cut a dividend. It basically is for unintelligent investors think, oh, they can't afford it. That's why they're not paying for it. When in reality, it's just maybe they want to use their cash better. They want to allocate their cash better. And so to me, I think that this is just me balancing out actuality with what I would prefer. And I don't necessarily think they'll do this, but I think it'd be smart. I think the best allocation of cash would just be one-time dividends, but who likes that as a dividend investor? If you're retired, you just like that free cash flow. You don't like one-time things. You want guaranteed. And so to me, that's why I say it's a balance. And so let me make some assumptions here on the price appreciation side. Growth has been pretty high recently, but I'm going to assume that it dwindles down a little bit. I'm going to say that they grow relatively in line with inflation and then have a 7 years from now PE and price free cash flow relatively in line with that. As for margins, let's look at the averages here. Let's do maybe 12 and 10% on buying back, maybe 0.5% of shares. And again, that's just to allocate a little bit of capital towards acquisitions still, and then allocate capital towards paying down that debt. And this gets us to a present value, this gets us to a price point that needs to fall 45% before you get a 15% return given these assumptions. I do think that the company's dividend is stable. I do think that their balance sheet, I do know that I've seen worse balance sheets. I'm not saying that 7 times their 5-year average free cash flow is not a little bit concerning to me, but it just depends on when those debts are due to see if it's really concerning or not. But I do think that a little bit more price fall and you get above a 4% dividend yield and you get a bit more possibility for price appreciation when you purchase this company, I do think it could be a great investment. So I would add this to my dividend screener or dividend yield portfolio and just wait, or dividend yield portfolio queue, I guess, and just wait until it gets to a price that's attractive for you. Because everyone's purpose for investing is different. It could be to just get as much free cash flow as possible from dividends. But for me, at my current age and my current desires in investing, I just want as much return as possible. And in most cases, it's a company that allocates capital best. But for me, hopefully everyone enjoyed the video and has a great rest of the day. Thank you.